Okay, so welcome back to the desk. We're going to move on now to our next self-awareness statistics. We're going to move on and look at some further parameters that you can actually use to track your ability and performance as a trader over the much longer term. The statistics that we're going to be looking at are very actually similar to what we looked at in the Kelly criterion, because if you remember in the Kelly criterion, our measure for R was really a ratio between the trades that we've made money on in the past and the trades that we've lost money on in the past throughout our track record or trading history. And this ratio, essentially, if you look at it from an outsider's perspective, and this is the key, you have to look at it almost from an investor's perspective. If you look at it from that perspective, what you're actually measuring is your upside potential versus your downside potential based on the past trades or history of a particular trader. And in your case, you're looking at yourself. Now, these statistics, it's all numbers, so it's all very objective. With the R score, this ratio, really when you look at it from an outsider's perspective, is the amount of return or upside that this trader will give you versus the potential downside that this trader will give you. And what we're going to look at now are similar statistics that are very common, especially in the hedge fund industry, for measuring a hedge fund's return over their risk that they're taking. So when they're actually going out to pitch for new investors' money, these statistics become very, very important for the investors themselves. They want to see the fund's performance in the past relative to the amount of return, relative to the amount of risk that they're actually taking. So the return relative to the risk. So what we're actually going to look at is the Sharpe ratio, the Sortino ratio, and the Kalmar ratio. And each one of these ratios is very common in the hedge fund industry in measuring return versus the risk taken throughout the history of the fund or the hedge fund trader themselves. So what you've got to do here is just understand how the performance metrics work, the principles behind it, learn the formulas, and then over time, make sure you measure your own performance. We're also going to look at what we have to actually do in terms of our calculations when we're adding money into our portfolio, into our trading account, and taking money out of our trading account. We obviously don't want to have returns that are positive in our portfolio, and when we put money in, these returns look like they've been embellished in any way. We want to actually adjust our returns for the money that's going in and the money that's going out. And likewise, if we're losing money and we're taking money out or even putting money in, we don't want our return statistics to actually be calculated incorrectly. So we want to always make sure that we're measuring our performance and ability as a trader accurately. Otherwise, we just don't learn anything about ourselves as traders. So let's go over to the computer screen. Chris Quill is going to take you through the formulaic process in Excel, how to calculate the Sharpe ratio, the Sortino ratio, and the Kalmar ratio. And then we'll come back here to the desk for a conclusion. So I'll see you at the end of the video and we'll do a recap.
In this video, we're going to run through some various performance statistics that you can use to track performance in your portfolio. So the statistics we're going to cover are fairly simple to use and easy to calculate, and they're also used industry-wide, particularly amongst hedge funds. So essentially, we're going to be calculating some annualized portfolio returns and risk levels and coming up with several risk return evaluation statistics so that you can get a deeper understanding of how your portfolio performs over time. So part one of this video is going to run through calculating annualized returns and risk levels, and then calculating the subsequent performance calculations. And part two will go on to how you can treat inflows and outflows of capital to the portfolio and how that affects the returns calculations. So put simply, when money flows into the portfolio, we don't want that to upward bias what we see as portfolio performance, and conversely, we don't want capital outflows to have a downward bias effect. So let's move on to the first part of the video. So to get any sort of reliable indication of portfolio performance, we need to have a decent set of data behind us. So by that I mean a good number of data points to work with. So if you were to record your portfolio total margin once a week, you would need about a year's worth of data to come up with any reliable performance statistics, so 52 or so data points. Generally, you also need to run your account for about a year anyway, just to get a good idea of performance, irrelevant of what the intervals you measure that performance over, for example, weeks, or even if you go down to days and you get more data points, it's still better to look at a portfolio performance over a year-long period or more, really. And obviously, if you're looking at monthly, you'll need more data points to get reliable estimates. So I'm going to start with about a year's worth of simulated portfolio margin data, and using that, I've got that created here in Excel. So yeah, this is just some simulated data for portfolio total margin from 2013 to 2014. Just a bit over a year, almost year and a half. And we're going to use these margin numbers to calculate returns, drawdowns, average annualized returns for the portfolio, downside standard deviations, and max drawdown figures. So those numbers are going to be used to generate three major portfolio statistics, which you may have heard of before. So one is the Sharpe ratio, then we're going to look at the Sortino ratio and the Kalmar ratio. So just to go through what that all actually means. So the average of the annualized returns is going to be the average returns in this portfolio, weekly returns, displayed in an annualized fashion. So we're going to compound that number by the number of periods in a year to get the annualized figure. So roughly 50 weeks. Drawdowns are best explained in a graph, so I'll just do that quickly now. So just insert a basic line graph of our margin over time. Just edit the graph so we can see it more easily. Okay, so this is the portfolio margin over time, basically portfolio performance over time. Drawdowns are just any period where we have a negative return, and then the maximum drawdown is the maximum uninterrupted consecutive drawdowns that we have in terms of a complete loss. So not the number of periods that we have that are negative, but the actual negative return generated by those consecutive uninterrupted negative periods. So for example, just eyeballing this chart, so from here, so the value of the portfolio is at 15,904 on the 31st of March 2014. Then it goes down to the next data point in April, and then again, so 7th of April, then 14th of April. They're all negative months, so that is one whole drawdown there. Like, that's one of the areas of the chart or the time series that we'll be looking at when we consider a maximum drawdown. So look, again, a good example up here. This isn't from here to here isn't actually the maximum drawdown because it's interrupted with a period of gain. So that's probably the easiest way of looking at it. So you should be familiar with standard deviations. The downside standard deviation is just calculated from only the set of returns in the portfolio that are negative. So the reason that we might look at that, and that's interesting to us, is that you can argue that since from a risk point of view you're chiefly concerned with volatility on the downside and not upside, so you're not bothered about limiting volatility when it means it's a profit to you, it's only when it's loss, then it sort of makes sense as a better measure of risk to measure the downside standard deviation. So we'll run through the Sharpe, Sortino and Calmar ratios in more detail later in the video, but put simply, the Sharpe ratio is a risk return measure using annualized returns versus annualized standard deviation. The Sortino ratio is the same, except we look at the risk side of the equation as downside standard deviation rather than total. And the Calmar ratio again is quite similar, except the denominator of the equation, the risk side of the equation, is the maximum drawdown figure rather than standard deviations. Before we get on to calculating the performance statistics directly, there's a bit more data and inputs that we need to build out, and I'm also going to run through how the rest of the spreadsheet is going to work, just by creating a bunch of sort of column titles and stuff to guide us through the video. So we're going to start by calculating some returns in column C, and then in column D we're going to just extract the negative returns from column C. And then in column E, we're going to calculate drawdown figures over time. Then we're going to calculate from those some more direct inputs into our performance statistics. So we'll need the annualized standard deviation, and the same, but the annualized downside standard deviation. We'll also need max drawdown figure, an annualized return figure, and also a risk-free rate. So I'll as we go through the video, I'll explain each of these in turn and why it's necessary. So finally, using these inputs here, we'll calculate the Sharpe ratio, the Sortino ratio, and the Calmar ratio. So let's start with column C, returns. We just use the standard returns formula that we've used throughout the video series. Copy that down for all our rows. And then to extract just the negative returns within column C, we'll use an if formula. So equals if, the logical test is if the cell in column C is less than 0, i.e. negative, then we want to return that value, and if not, leave the cell blank. Those two speech marks mean leave the cell blank. Copy that down. From there, we can start thinking about calculating our drawdown numbers. So remember that a drawdown is the negative return over consecutive negative periods. So for each negative return that's on its own, that will be quite simply the drawdown figure. But for periods of consecutive negative returns, the drawdown figure will calculate by creating another return based off the portfolio margin for this whole period. So we're going to take the portfolio margin at the end of the consecutive negative returns minus the portfolio margin before, and then divide it by the portfolio margin before. And we'll do that for all the ones that have consecutive negative return months. And for the ones that are just on their own, it's fairly simple. You just calculate it by extracting the negative return for that period. I'm just saving some time here by copying the formulas down and editing them where necessary. So it's a little bit of a manual process, but that's probably the easiest way and most understandable way to calculate drawdown figures. And we can format all those cells to display themselves as a percentage. Okay, so moving on to the final inputs before we get on to actually calculating the performance statistics. The annualized standard deviation is just going to be equal standard deviation of our returns column times by the square root SQRT of 52. Now the reason we times it by the square root of 52 is basically to scale up a weekly figure to an annual figure. So there's 52 weeks in a year, so we scale up our weekly standard deviation figure, which we calculate in this part of the equation, times it by the square root of 52 to annualize. So that's just how you annualize or scale up and scale down standard deviations, is times it by the square root of the number of periods in the over the time period that you want to scale it up or down to. So we can copy that across to the annualized downside standard deviation. So that's now using the negative returns only and doing the same thing. Max drawdown, all we do is we want the absolute value, so we want a positive number here, even though we know a drawdown by definition will be a negative return. We're going to return it as a positive return, so to do that we type ABS for absolute, and then we're going to take the minimum of the drawdown column. So we get a max drawdown figure of 3.96%. Our annualized return is going to be equal to 2 brackets 1 plus the average of our returns column to the power of 52 to scale it up to an annualized figure, and then minus 1. And if we change that to a percentage, that's our annualized return figure. And then the risk-free rate. So the reason we need the risk-free rate in these performance statistic calculations is because essentially when you, as I said previously, these are all risk return measures. So basically they'll all have a return number on the top of the equation and then divide it by a risk number to come up with a performance ratio. And the numerator, so the top of the equation that calculates the performance, the return, is then adjusted by the risk-free rate so that we only reward ourselves within the ratio for returns that are above a risk-free rate of return. So the risk-free rate is an interesting concept. It's used quite a bit in finance, and it's debatable about what number you can actually use for the risk-free rate. But for our example, and it does work generally through finance, you can take a short-term treasury bond or bill. So we're going to use the Fed Treasury yield curve. So I'm just going to go to Google and Google Fed Treasury yield curve and just extract the latest 1 year Treasury yield. So that is 0.13%, and just put that in here as decimal. Then we can change it to a percentage. Okay, so these are all our inputs now that we can use to calculate the Sharpe, Sortino and Kalmar ratios. So let's move on to that, and I'll explain a touch more about them as we go through. So the Sharpe ratio is just the annualized return minus the risk-free rate divided by the annualized standard deviation figure. So we've got a figure there of 0.98. Now, so that's looking at that equation. It's got on the numerator of the equation, it's analyzed our return, so annualized return. It's taken away the risk-free rate, so we only analyze our risk-taking return, and then divided it simply by the annualized standard deviation. So a value of 0.98 when you compare it to industry is okay, not that great. Generally, Sharpe ratios above 1 are considered good, and above 2 are very good or excellent. So we'll move on now to the Sortino ratio. That's very similar. All we do is alter the bottom of the equation, the denominator, to annualized downside standard deviation. So again, we've got returns on the top, risk on the bottom, and we create a performance ratio out of that. The reason why the Sortino ratio uses annualized downside standard deviation is through a fairly basic argument that suggests that the standard deviation or the volatility that you care about, the risk that you should care about as a manager of a portfolio, is really downside risk, and you're not too concerned with upside risk. So the Sortino ratio argues that this is a better measure of performance by just punishing you for the downside volatility, not upside. And naturally, this tends to run a bit higher than the Sharpe ratio. So good Sortino ratios might be 2 or 3 and above, essentially. Moving on to the Kalmar ratio. So this is our only performance statistic that we're looking at that doesn't use annualized standard deviations as the risk measure in the equation. Instead, we're going to use the max drawdown figure. And the Kalmar ratio doesn't actually take into account the risk-free rate either, so it's quite simply the annualized return divided by the maximum drawdown figure. And really, the Kalmar ratio is more appropriate to use over a longer time period than what we've got here. So here we're looking at about 1.5 years or so. Industry standard really is to look at the Kalmar ratio over a period of at least 3 years, just purely on the basis that you could easily not have a large drawdown within 1 year or so, but within 3 years, just historical performance of markets and so on suggests that you're more likely to have a drawdown figure, and this ratio becomes more appropriate at that stage. So this portfolio has a Kalmar ratio of 2.56. Anything above 2 is considered good. Well, probably 1 to 2 is considered quite good. Above 2 is very good. And then if you get anything above 5, that's excellent performance over the period that you're looking at. So now you've got some performance ratios to essentially quantify how well you're doing with your portfolio over time. And these sort of ratios are worth updating, say, every quarter or so, just so you can track your performance going forward. So that in itself should help you improve portfolio performance going forward. Another possibility to think about is that you could calculate, I've just realized that I've put Sharpe, not spelled Sharpe correctly there, Sharpe ratio. Another possibility is that you use these performance ratios going forward for different segments of your portfolio, so you can start dividing up your portfolio and seeing which aspects perform best. By that I mean a standard portfolio management approach, shorter term trading approach, or you could break it up by asset class and so on, so you can dissect your portfolio performance and then add value to the parts of the portfolio that do best and reduce those that don't do as well. So as I went through earlier in the video, we're now going to spend part 2 of this tutorial on looking at how you record inflows and outflows of capital, and how that can affect portfolio performance if you don't account for it correctly. So we don't want inflows of capital to upwardly skew our portfolio performance, and vice versa for outflows of capital. So to go through a couple of examples, I'm just going to take the last 5 periods of data and copy that as values into sheet 2. And in the first scenario, the easier scenario, is that the inflow, we're going to look at an inflow of capital that takes place on the day that we record our weekly portfolio margin anyway. So on the 25th of August 2014 here, we're going to say that we inject some capital into the portfolio. But as far as recording the performance goes, so the returns of the portfolio, what we're going to do is on the 25th, we're going to record the total portfolio margin before the capital inflow. So I'm going to make up a number here, 17,200, and record the returns value for that week as standard. Now the following week we're going to have another certain amount of money in the portfolio margin, plus or minus performance as well. So let's use an example of injecting 5,000 into the portfolio. So, and we'll add a bit of performance, so we'll make it 5,100 on this number here. So just to make it easy, so the portfolio margin on the 1st of September is 22,300. 5,000 of that is just capital injection, and 100 like from the previous week, and 100 of that is performance. So to record the actual returns, what we do is basically use the same sort of returns formula. So we'll use the current margin minus the previous margin, but in this scenario we're going to put the previous margin plus 5,000 because we injected capital on that day in the week, and then divide it by the previous value plus 5,000, and that gives us the correct portfolio return figure that isn't upwardly biased like it would be if you just didn't add 5,000 into that equation. So that's quite an easy example to think about when you add capital on the day of reporting, if you like, during your weekly reporting period. So that example is quite simple because we have capital inflow on the reporting day of the week. Let's go through an example now of where we have capital inflow during the week, so between reporting days. So instead of the capital being input into the portfolio on the 25th of August here, we're going to say that actually midweek on the 28th is when there was a capital injection. So all we do there is first of all apply similar principles to above. So on the 28th we record our margin value before the capital inflow, say 17,300, and work out the return for that period. So that's half a week, the first half of the week. But to record the weekly performance value, which we put on this row, so what could be easier as well when you record this is if you can expand and collapse this row, because it's not your reporting day of the week. So you can do that by highlighting the row there, like I've got row 15, and then holding Shift Alt and right, and then that will add this little expand and collapse icon here. So to work out the returns for the next week, you record your portfolio value for that week. So let's call it 22,400, and the return formula changes slightly because you need to take account for the two halves of the week, their returns sort of separately. So, or compounding each other really is the best way to put it. So to work out the return, we do equals 1 plus the return for the first half of the week times by 1 plus the return for the second half of the week, and then all of that minus 1. So the second half of the week has returns of 22,400 minus 17,300, but remember we need to add the capital injection, so it's minus 17,300 plus 5,000 divided by 17,300 plus 5,000. So you need to make sure that you've got these brackets displayed correctly as well, and then close the whole equation with another bracket and minus 1. And that should give you a return for the period from the 25th of August to the 1st of September, i.e. the standard weekly reporting period that you want to record, by taking account of the returns midweek and then midweek to end week and compounding them. So we get a return of 1.03%, and then all you do then is just close that, and those are your returns. So the only issue then that you might run into is when you use these columns to do your performance statistics, you don't really want to include this in your portfolio statistics. So you could just basically shift those across. So select 5 cells in a row, right click, insert, shift cells to the right, and do it that way. And it won't destroy it won't upset the formulas here, because they'll automatically adjust based on those movements. So but you won't include the return statistics in your portfolio performance numbers, because it's now not in column C, D or E, or whatever columns you end up using. So hopefully that's added some clarity about how to not skew your portfolio returns, your performance statistics, and make sure you record your margin numbers and returns correctly. In terms of outflows of capital, you just do exactly the same methods that we've discussed, but you just minus the flows rather than adding them, because it's an outflow, but you do exactly the same method.
Okay, so welcome back to the desk. What you saw there from Chris were three very important metrics: the Sharpe, Sortino and Kalmar ratio, that are really widely used in the hedge fund industry to track and assess the abilities of a fund or a particular trader. And as mentioned previously, these statistics, they're all about the return over the risk and assessing from an investor's point of view what upside do they get versus the potential downside. And there's different stats, they're worked out differently, but they're all essentially put into that basket. That's what we're looking for as investors into traders. And I can say that very comfortably that these statistics are important because I personally invest in quite a lot of traders. So it's calculating the return of a trader over time, over the risk, very similar to Kelly in terms of the R-score. And you should always look at this from an investor's perspective. What do investors want to see? They want to see a trader who over time gives them potential upside that's greater than their potential downside, regardless of which measurement you use. And if all of them are used, fantastic. So if your ratio is above 1, that's good, that's a good start. If you're tending towards 1.5, 2, that is excellent. If you're above 2, you're killing it. So that's exactly how you need to look at it. Over time, you need to think as a trader, this is what I want to achieve. Because from those metrics, if you do start achieving this over time with real money, people are going to start to get very, very interested in you in terms of investing money into your trading account, or inviting you on power of attorney to trade their money in their trading account, whether that's on an individual or corporate basis, or interested in taking an investment with you to go and set up a fund. So the investor is always concerned about the risk-adjusted returns, or calculating potential upside versus potential downside, not necessarily just how much money you made. So this is what you have to be doing as a retail trader. Get out of this mentality of, for example, going right back to the video series of having a trading account and trading a certain amount of money and just trying to go for quick, big returns that are taking excessive risk. You know, no investor is ever going to give you money if you pursue that route. You've got to be consistent and grind out smooth returns with ratios of the performance statistics, the self-awareness stats with smooth returns with ratios above 1 or well above 1. And the numbers are objective, they never lie. So it tells an investor everything they need to know. Now, because you don't have a boss and these statistics are objective, this means you can actually look and step outside yourself, look at yourself as a trader from an investor's perspective, and assess your own performance and abilities and strengths and weaknesses over time. Now, obviously, these things take time. The next thing you've got to do, you know, we're now coming towards the end of the video series here. All we've got to do now is prepare for the exam. And what you've got to do is start really the hard work, which is actually turning what you've learned right here in this video series into real money. You've got to turn it into profit. And the only way you're going to do that is to actually trade with real money. And a trader's career or trader's development occurs in 3 well-defined steps, whether you do it through the institute or you do it outside. It really doesn't matter. You've got 3 very simple defined steps. If your objective is to go into the industry, you've got to get the foundation, the educational foundation, which you've received to this point. Take the exam, and then you've got to move on to the next stage, which is implementation, doing it with real money. No demo accounts. It doesn't count. It doesn't mean anything. You have to do this with real money and do it with a decent number in your trading account. The minimum at the Institute is £10,000 deposited on margin, or around 15,000 US dollars. prove that you can do it to yourself and prove that you can do it to other people. And if your objective is a career in the industry, you move on to the next step, which is profession. And profession is based on your track record. So 3 very well-defined steps. If your objective is to simply make money using your own money, then that's totally fine. You can do that inside the institute or outside the institute. You'll just simply stop on step number 2, which is the implementation phase. So instead of having educational foundation plus implementation with real money, plus turning it into a career, you'll simply just have educational foundation plus implementation with real money, and you'll continue to learn and keep building your education continuously as you keep going throughout your own personal development. So these are the choices you have, and it can't really be put any other way. This is how a trader develops, and this is how a trader progresses in their career. These statistics that you've looked at will become really important once you start trading with real money and building yourself a track record. And I know this personally because we can only invest in people ourselves if they have good solid track record of a minimum 9 to 12 months, and then we can invite people on power of attorney. But first you've got to take the exam, and then after the exam the hard work begins, because you have to do it with real money. So let's prepare for the exam, and I'll see you in the next video.